Hey everyone, welcome back to the Beyond MD podcast. And I'm back after a bit of a break. I had a chance to visit Japan with my family for 2 weeks over March break, and I can tell you that this was the most incredible trip I have been on so far. I was so moved by the calm and respect in the Japanese culture, and every corner I turned, there was so much history and there were so many signs of grit. We started off in Tokyo, went to Kyoto. I loved Kyoto and the surrounding area. And then we went down south to Nara for a day trip, backtracked to Hakone and the mountains before wrapping up the trip again in Tokyo. And I was so blown away by this country. It was the most efficiently run place I've seen. And start to finish, I was so impressed that I decided to summarize everything that I learned and observed, and I put it together into a newsletter, which was the most recent issue that I released about a week ago. And I did this because I'm continually striving to find ways to live a better life here. And I found inspiration in my trip to Japan. So if the newsletter is something that you're interested in, you can go to beyondmd.ca, hit the newsletter tab, and enter your email to subscribe. And right now, I am releasing issues of the newsletter once every 2 weeks. So today, we are diving back into the wealth formula, and we are talking about financial wealth in this case. I have covered the first few steps of the wealth formula in recent episodes, but we'll go over the formula again. So, step one is having a steady income. Step two is spending less than what we earn and spending in a meaningful way. Step three, which is the focus of today's episode, is investing the difference. And then step four is understanding our definition of enough. When it comes to investing, today's episode, I'm going to be spending most of my time talking about investing in the stock markets. Most of my investments happen into the markets. I also have real estate investments and a few private investments. But investing in the markets is where I spend most of my time, and it's what I enjoy the most. And if you are more of a visual learner, I also have this episode on YouTube, and there are a few graphics, so you can feel free to check that out as well. So let's dive into the first concept, and that is investment returns versus investment effort. And this is a concept that I came across in the 5 Types of Wealth by Sahil Bloom. So there are certain investments in life that are going to involve a lot more effort. And we have to figure out if the returns, given that level of effort, make sense for us. We have to find our sweet spot. And it's important to do this because time is our most precious resource. So if we start really low on the effort scale, that is simply leaving money in our bank account and letting it accumulate interest. And that is going to result in a very low return. Next, we can put in slightly more effort and generate substantially more return by investing into the stock markets through exchange-traded funds, which are ETFs. Further down the effort spectrum, and I would say in my experience, this involves a lot more effort, but this is investing in individual stocks and investing in them passively, buying stocks and holding them for the long term. There is data that may argue that majority of people who take this approach will not outperform the market. But there are some people who do manage to outperform. Regardless, for most people, that outperformance is going to be very small for a lot more effort. Now, even further down the effort spectrum is actively investing in stocks, buying and selling more frequently, even trading, a lot more effort. And one could argue that the potential returns are very small here, in excess of these other strategies that we've already talked about. So a lot of effort for maybe a slightly more return. In my experience, even further down the effort spectrum is investing in real estate, which is not passive. Even if you have a property manager, you're managing your managers. So a lot more effort, but if done right and bought right and held over the long term, potential for slightly more return. And then furthest down on the effort spectrum, but the potential for highest return, is starting your own business. So think about these concepts, about the returns that you want and the effort you want to put in. And I think it's important for all of us to find our sweet spot here. For me, that sweet spot is a combination of ETFs and individual stocks held for the long term, about 50% in each. So how much money can we make with investing? Well, let's say we generate a 7% return for the long term. So the amount that we're going to make is based on the amount of money we put in multiplied by 1.07, and the exponent here will be the number of years that we invest, time. What's interesting is that we can play around with certain parts of this formula. In fact, certain parts of this formula are directly within our control. Returns are less within our control, but the amount of money we put to work is in our control. And most importantly, time is within our control. So let's move on to an interesting example where we change the exponent, the time that we are investing for. So here's an example. Let's say we have an individual who's investing $2,000 per month, and let's say that they are generating an annualized return of 7% per year. So let's say that they start early on and they invest for 35 years. This scenario results in a nest egg of $3.4 million. Now let's compare this to somebody else who says that they're just starting work and they're way too busy to think about money and investing, and they want to delay things for 5 years. So instead of a timeline of 35 years, we have 30 years. Everything else stays the same. We're investing $2,000 per month and we're generating a 7% return per year. This results in a nest egg of $2.3 million. And the question I want to pose to everyone is, let's say this individual who started 5 years late wants to get to that 3.4 million end target. How much more money would they have to put in per month to reach that $3.4 million? And when I played around with these numbers using a compound interest calculator, the answer, it surprised me. The answer is 50% more money. This individual would have to put in $3,000 per month. And this concept holds regardless of how much you're investing. If you delay your investing journey by just 5 years, you will have to put in around 50% more per month to reach that same end target. So time in this case is our best friend, and time is within our control if we start on day one. This is why I say that we should have an inclination to act. We should have a desire to invest today. And there's no better way for me to illustrate this than a story through the podcast. So a little more than a year ago, I got a call from a retiring physician. The call came from Hospital Locating. They called to say, thank you for the podcast. And they had a question, but I paused them and I asked them about what they had done well. What went well in their investing journey? And they gave me this example. In 1989, this individual bought a single share of Berkshire Class A stock. In 1989, that share cost $5,000. And I asked them what they did. They just sat on their hands and they let it ride. So the conversation happened in 2025, and this individual held this share all the way until then. It turns out when they were about to sell the share, it was worth $790,000. There are some incredible things about these numbers. The first is that time does wonders, and time is what leads to exponential growth, especially in the later innings. So the first thing that really struck me is the amount of gains that this individual was going to realize here. $5,000 to $790,000. That is outstanding. But what was even more shocking to me was when these returns happened. It turns out that more than 2/3 of the returns were just in the last 5 years alone. This is what exponential growth is about. This is why it's important to think long term, because the majority of growth is going to happen in those later innings. Now, some may argue and say that, hold on a second, the US markets have performed exceptionally well since the great financial crisis. And that is absolutely true. Since the lows of 2009, the S&P 500 has had an average annualized return of around 15%, which is far higher than the long-term average. However, we don't have that much control over our investment returns. But we do have control over other things when it comes to investing, and I feel like this is where we should be focusing our time and our energy. So we are in full control over when we start investing. We also control how much we can invest on day one and on a monthly and quarterly basis. We have control over where we invest our money, and we should do so in a tax efficient way. Our registered accounts are useful, and our corporation is also useful, especially when it comes to things that tend to grow, appreciate in price, and Canadian dividends being a bit more tax efficient than foreign dividends in a corporation. We also have control over our asset allocation, and that should be based on our risk tolerance. We also have control over investing in things that we understand. That is one of my top rules. I will now, after many years and many lessons, I will invest only in companies where I have an understanding. We also have control over keeping our investing costs low. This is critical. We also have control over diversification. And it's said that diversification is the only free lunch in investing. And then we also have the ability to think long term, just like that physician in the example with Berkshire stock did. Market returns are less in our control, but a little bit more on this concept later on. When it comes to investing, I do want to touch on one concept that I find very important. It's taken me many, many years to learn this, but it's signal versus noise. And I was reminded about this concept through an exceptional book called Essentialism by Greg McKeown. And the book Essentialism is about the disciplined pursuit of less. And I think this is very relevant when it comes to our investing journeys. Early on in my investing journey, I had a tendency to spend far too much time on the Yahoo Finance app. I was getting alerts multiple times a day. I would be tracking every single news article. I would be hitting the buy button on every 5% drop. Whereas now I have found that it's a much better strategy to just take a step back and absorb less information. Yes, you should be following your companies carefully if you are investing in individual stocks. But once you get a good grasp of these companies, there's really nothing that is materially changing from quarter to quarter. It's the quarterly reports that matter. So I would say focus on those quarterly reports, tune into the earnings calls, read your favorite investing books, follow a few people, but you don't need to follow every YouTuber. You don't need to read every article that comes out because most of it is noise. And we need to spend time focusing on signal over noise. So a few minutes ago, I mentioned that we don't have much control over the returns that we are going to get. But it turns out that there is some data that can help us glean insight into what expected returns may be. And for this, I'm going to bring you to Lynn Alden's website. She has a phenomenal blog, and here she talks about the concept of the CAPE ratio, the cyclically adjusted price to earnings ratio. So first, let's just talk about what the price to earnings ratio is. For a certain company, the price to earnings ratio, the PE ratio, is the price of that company, the share price, divided by the earnings per share for that company. And the same logic can be applied to an index like the S&P 500, which is what we are going to talk about here. So to smoothen things out over a slightly longer time frame, we have the cyclically adjusted price to earnings ratio, which basically for an index will take the average earnings for the last 10 years, and then it will take the current price of the index and divide it by those averaged out earnings over the last 10 years. And you get the CAPE ratio. This is also known as the Shiller ratio, and this was devised by Robert Shiller, who was an economist at Yale University. And Robert Shiller still publishes the most up-to-date CAPE ratios on his website, and for those interested, I'll have a link to that in the show notes. But what this graph on Lynn Alden's website shows is that when CAPE ratios were high, expected returns over the next 20 years were not good. In some cases, they were barely positive, and in some cases, they were close to nothing. So some examples here: in the Great Depression, we have examples in the 1960s, and then we also have the dot-com bubble, parts leading up to the Great Financial Crisis, and not shown on this graph, but what did happen, and we will talk about this shortly, is in 2021. Now, one caveat is that if you look at this CAPE ratio, over time it is going up and to the right, and history supports this. So between 1953 and 1983, it turns out that the CAPE ratio averaged around 15.5. But since 1983, the CAPE ratio has averaged 24.5. And you might ask, well, what's the CAPE ratio today? And how high was it in these other periods when it was elevated? So it turns out that in January 2026, the CAPE ratio reached 39.5. This compares to 43 in the dot-com bubble. This compares to 38 at the end of 2021 before the drawdown in 2022. And today, the CAPE ratio is somewhere between 37 and 39, probably closer to 37 with the recent dip in the markets. And I want to be clear, I'm only bringing this up for awareness. I am not trying to stoke fear. I'm not trying to discourage people from investing whatsoever, because it turns out that investing in periods of time that end up being lost decades where the markets don't do very well can be the best thing for our future long-term returns. Because let me give you some numbers that I came across from an article that I read. This was by Andrew Hallam, who is a personal finance expert and an author of some of my favorite books. So to illustrate, I'm going to go through a few numbers. So let's go over 3 different scenarios. And in each of these scenarios, we will be investing over 30 years. So let's go over scenario 1. In scenario 1, we're investing $10,000 per year. And for the first 15 years, we're getting a very strong return of 15% each year. Now, for the next 15 years, we're still investing $10,000 per year, but we're getting a very low return of just 2% a year for the last 15 years. So think about that. In this case, this strategy results in a nest egg of $920,000. Now, let's compare this to scenario number 2. Here, for the first 15 years, we're investing $10,000 per year, and we're starting off with a really low return, that 2% per year, for that first 15 years. Now, the next 15 years in this scenario are better. We're getting an annualized return of 11%. So ask yourself, which scenario is better? Scenario 1 or scenario 2? Remember, scenario 1 had the good returns at the start. Scenario 2 had the very low returns at the start. So scenario 1 resulted in $920,000. It turns out that scenario 2 results in $1.2 million. This is why a lost decade where we have very low returns and constantly investing through that time frame can work out for us long term. And I'll put a third scenario in place here, and that is you're investing $10,000 a year for 30 years straight, and you're just getting 7% returns. Well, this scenario results in $1 million. So the numbers show that having poor returns at the start can work out long term. This is why having a lost decade of stock market returns can in fact work out for an investor who has a long enough time horizon. And this brings me to that analogy of the barrel of apples that came up with my discussion with Paul Healy. Paul had mentioned that if you stick to your plan of regularly investing, whether it's weekly or monthly or quarterly, you're going to get some stocks at bargain prices, stocks at fair prices, and sometimes you'll be buying stocks at high prices. But when you look at that barrel of apples, overall, the average price is not bad at all, and it's probably going to work out long term. Now, the last thing that I do want to talk about today is geographical diversification. And for this, I'm going to bring up this chart from Wealth Simple. And this basically looks like a blanket, a quilt. And it basically shows that over time, it's really hard to predict what part of the world is going to have the strongest performance. So in the 2010s and 2020s, the US markets outperformed other parts of the world. But when you go back to the 2000s, the US was the second worst on this quilt, right after Japan. And when we go to the 1970s, the USA was dead last. And it's really, really hard to predict this. And I've had to rethink some of this as I have shifted my investment strategy, because what's happened is over time, I have become more concentrated in certain companies. One example that I'll use for this discussion is Amazon. And there has been quite a bit of talk amongst investors that if you're investing in a company like Amazon that has geographically diverse revenues, then maybe there isn't such a need to pursue geographical diversification within our portfolios. I don't think that's the right way to go, and I'll explain why in a second. So, if we look at Amazon's revenue, 20 to 30% of Amazon's revenue comes from outside the US. And this has been the case for the last 6+ years. And it made some of us think that if revenue is so diversified, do we need to diversify geographically? Well, I think the answer is yes, because let's look at what happened between the end of 2021 and the start of 2023. Despite having revenues from all parts of the world, Amazon still saw a fall in its share price of more than 50% in just over a year. So it was certainly not immune to a sell off. So I think what this experience has taught me is that it's important to be geographically diversified. And so I do this through ETFs, and I will continue to do it moving forward. So, guys, that is a wrap for today. Step 3 in the wealth formula. I hope you found that useful, and I look forward to seeing you in a few weeks' time. Until then, stay well, stay savvy.